The IRS has its eyes on cryptocurrency investments. If you've traded or sold any type of cryptocurrency last year, here's what you need to know before the tax day. In 2014, the IRS issued one notice, IRS Notice 2014-21-2014-16, IRB 938 about cryptocurrency. Let's call it the Notice 2014. This is considered a tax authority, although it does not have the same weight or effect as a law or regulation. But it's all we have so far, and given no other official IRS guidance, it's pretty informative about how the IRS thinks about cryptocurrency. The 2014 notice provides a very high-level background on how the existing tax code applies to cryptocurrency and how the IRS views it as a property. This classification as property requires a lot of effort on your part. Most importantly, you need to know the adjusted cost of your property, cryptocurrency, so you can determine your gain or loss when you go to trade or sell that property. Typically, the basis is first determined by cost, in other words, the amount in US dollars you paid for the property, and adjusted by certain events. This might include stock splits if you held a stock. Each Bitcoin you have will have its own cost base, and it is possible that this cost base needs to be adjusted as you hold the Bitcoin, although adjustments to base are still unclear in the cryptocurrency context. There is still no global reporting mechanism to confirm adjusted basis for people who bought or sold cryptocurrency in the past year and are now in the process of figuring out the gain or loss. So if you do not receive any types of reports from your investments, which is not unusual, you will have to determine the adjusted base and any associated gain or loss on your own. Moreover, you will need to track the character of your gain or loss from your cryptocurrency sales or trades. The character depends on whether virtual currency is a capital asset in the hands of a taxpayer. To make these determinations, you will likely have to go back through your bank or wallet receipts and emails to find out what you paid for cryptocurrency in US dollars, or the US dollar equivalent of another cryptocurrency, to determine the cost basis of the property in question. Then you will need to consider whether you have engaged in any events since the date of acquisition that require adjustment to the basis. Ultimately, that should get you to the adjusted basis at the time you sold or exchanged the property. And if you only sold or traded a portion of your cryptocurrency, you will need to determine which part of your adjusted basis was sold or exchanged. Most often, FIFO, or a first in, first out method, is applied for this determination. It's a challenging endeavor for those who just started investing in this area and could be almost impossible for early adopters, who may not have kept detailed records. Nevertheless, the IRS has said that it expects taxpayers to comply with the general tax law for all virtual currency transactions, even those enacted prior to the 2014 notice. If you do not, there is potential for penalties or audits. Adding another layer of complication is when cryptocurrencies are mined instead of bought with cash. You will need to determine if you were an employee or independent contractor mining for someone else, if you were getting wages for mining cryptocurrency, if those wages were in US dollars or virtual currency, and how much each of those transactions was worth in US dollars on the day they were recognized as transactions. If you were mining for someone else, your earnings are considered wages, subject to regular wage withholding by your employer. If you were doing it as an independent contractor, those earnings should be considered self-employment earnings. In other words, those earnings will not be reported as capital. So you have both the initial difficulty of determining the fair market value of the virtual currency and the added complication of properly categorizing your mining activity. Note: This assumes that employees or contractors get paid in cryptocurrency, regular salary paid in cash, and similar payments are treated under standard income tax principles. If it sounds complicated, it is. Here are a few ways to prepare yourself for a tax filing. 1. Do not neglect to report any amount of cryptocurrency gains or losses from your investments. Be mindful of the limitations on the losses that could apply. For example, general capital losses of individual taxpayers, as opposed to ordinary losses, which are subject to special rules, are limited to $3,000 per year. If you sold a portion of even one Bitcoin for any amount of money, even a small amount, the IRS has made it quite clear they expect you to make the best efforts to report any gain or loss triggered by the sale. The IRS, in fact, reinforced this position on March 23, 2018, by releasing a reminder to taxpayers to report virtual currency transactions, and stated in the reminder that taxpayers who do not properly report the tax consequences of virtual currency transactions can be audited for those transactions and, when appropriate, can be liable for penalties and interest. 2. Start an ongoing spreadsheet that captures when you bought a cryptocurrency and how much it was worth in US dollars on that day, when you sell or trade it, and how much it's worth in equivalent US dollars on that day, what you sell or trade for it, and the value of what you get in return for that sale or trade. Make efforts also to track any possible adjustments to the cost base in your cryptocurrency, such as splits or forks, even if it is still unclear whether those adjustments should be taken into account. In the long run, it will serve you better to get everything in order now, as more regulations are expected, and they may increase your reporting requirements. 3. Think more broadly about what you do with your cryptocurrency beyond strictly selling it. As I said above, the tax law considers convertible virtual currencies like Bitcoin to be property. If you trade Bitcoin for real things like a cup of coffee or goods on a third-party website, technically, that's a reportable transaction for tax purposes. And Uncle Sam wants a cut of any gain you earned on the transaction. It's not intuitive that you would have to report this. So pay special attention to tracking the value of the good you bought and if that value resulted in gain or loss compared to the adjusted basis of cryptocurrency on that specific day. If you track those things and report accordingly for tax purposes, you will be in a much better position to defend your actions in the audit. 4. This trading concept applies to inter-cryptocurrency trades too. If you trade one type of cryptocurrency for another, it could also trigger these same issues. Under the previous law, a trade of one cryptocurrency for another could in some cases be regarded as a tax-free kind exchange. Some cryptocurrency investors relied on that principle to treat cryptocurrency swaps as tax-free like kind exchanges. The most recent tax reform has made this impossibility, since now all kind exchanges are now required to be exchanges of real estate, such as exchanges of rental houses or commercial buildings. So for those who are exchanging cryptocurrency, you would still need to determine the adjusted basis of virtual currency on the day you traded it and see if it was worth more or less than the currency you exchanged for on the day you swapped it and report gain or loss accordingly. To recap, cryptocurrency has to be looked at as a property, not cash, when doing a tax return. So if you bought Bitcoin or a similar convertible virtual currency as the sole investor during the year and have held onto it, with no dividend or fork, which could lead to other tax complications, you probably do not have any reporting obligation. But if you sold or traded last year, you may have to report your profit or loss to the IRS. So grab a spreadsheet. As cryptocurrency becomes more legitimate, the rules become more significant. This article is provided as a general information and should not be construed as a legal advice.